Hello everyone, welcome back to my YouTube channel. Myself cajoshikumar. In this video, we are going to cover SEZ, very important for exams. So watch this video till the end. This is going to be a quick revision. Before getting into the topic, a little bit of background for better understanding. Okay, back in 1990s, India saw a slow growth in the exports, but we didn't have proper infrastructure. Our procedures were complicated, taxes were huge. Okay, but if we have to compete with our competitors like China, we need to build a world-class infrastructure. Okay, so that is when India has come up with special economic zone. Okay, so here India has created small areas as special economic zones, and for people who are doing business from these areas, especially if they are doing any kind of exports, for them there is no tax, like the benefit of tax was given to them. Okay, so this was attracting a lot of investors came from foreign people have invested in special economic zones, and people from other places in India who have money, they started investing in special economic zones. Okay, they started doing business from these areas. Okay, so that's how our infrastructure has developed, and we were in a position to compete with our competitors. Okay, so that's how SEZ has come into place, and we got deductions under section 10AA. Okay, so this was back in early 2000s or 1990s. Okay, but by the time we reached 31st March 2020, government said enough is enough. Okay, now all those people who have got approvals, all the necessary approvals by 31st March 2020, and who have started their business by 31st March 2021, only for them section 10AA deduction is applicable. Like now we are in 25-26, if you're starting any unit in SEZ, you won't get this deductions. Okay, so this is what you call, this is outdated, not for the exams but in reality. As long as this chapter is there in your books, you will get a question from this. Okay, so why am I saying outdated? Because you will remember the date 31st March 2020, very important. Okay, and then they should have commenced their business, manufacturing article thing or providing any software services by 31st March 2021. That is the first thing. And then second thing, like you should have a SEZ unit. I'm talking about applicability part. There should be a unit in SEZ, and that unit should manufacture something or produce any article or thing, or provide computer software development services. If they're manufacturing this and exporting to other countries, only for them section 10AA deduction is applicable. Got it? So this is your applicability part. And now let's see what is the deduction. Like if you see amount of deduction, it's very easy. For the first 5 years, 100% of the export profit is allowed as deduction. No need to pay tax. For the next 5 years, 50% of the export profit is allowed. Okay, and then for the third, fifth term, it said whatever profits that you are reinvesting into the business, you got profit, and whatever amount that you are reinvesting, up to 50% of the export profits, we will give it as deduction. Okay, so amount credited to SEZ reinvestment reserve account or 50% of the export profits, whichever is lower, is allowed as deduction. Okay, so this is the deduction part. Now we are saying 100% of the export profit, 50% of the export profit. What is an export profit? It is very easy to calculate it. See, whatever profits that you have got from the SEZ, multiply that with export turnover. Okay, and divided by total turnover. Simple. You will get export turnover related profit, and that is exempt. Okay, तो यहाँ पे एक चीज़ याद रखना, whenever you are doing any export, the amount should reach India within 6 months from the end of the financial year. Okay, only then you can consider that in your export turnover. If you're not able to collect the amount, if you're not able to receive the amount, then you cannot take that into export turnover. Okay, very important point. Definitely these points will be tested. All these are related to your practical question. Okay, this will be tested in your practical question. Okay, now we are talking about export turnover and total turnover. Law specifically says that there are certain expenses or incomes you should not include in export turnover or total turnover. Okay, if you see on the left hand side, there is freight, telecommunication charges, insurance, and expenses for providing services outside India. If you see, all these four are P&L items, all these four are expenses. How do you calculate? You say this is my cost and add a little profit to it. Okay, and then sales is your turnover, right? That's how you do. So what the law is saying, don't take this in your cost only. So they are saying don't take this in your export turnover or total turnover, all these expenses, because these are not adding any kind of value. These are pass through expenses. Like you incur these expenses, what you are doing, you are saying cost plus profit, and you are collecting this amount, and you are collecting that amount from your the person who's buying from you. Okay, so these are pass-through expenses. These are not value-added expenses. Okay, that's why the standard is saying that don't include this and don't inflate your export turnover. Okay, and then on the other side, if you see cash compensatory support, duty drawback, profit on sale of import entitlement licenses, all these three are incomes. They are taxable under PGBP. Okay, but these are not related to your exports. Okay, these are not your export related income. Okay, we will give deduction under 10AA only for your exports. Okay, so don't add these in your export turnover or total turnover. Don't inflate your export turnover or total turnover is what the law is saying. If you look from the logic's point of view, it is very easy to remember. Okay, so these are called ancillary profits and taxable under PGBP. Okay, but you will not include them in your 10AA section for calculating deduction. Got it? Chalo. See, export turnover, I told what I told. You should receive that amount within 6 months. Only then you will include in export turnover. But total turnover में वैसा नहीं. Even though you are not able to receive the in convertible foreign exchange, you will still include in total turnover. Like in denominator you are including, but in numerator you are not. So that is, this point is clearly from department's favor. Okay, we can't do anything. Just accept and move on. So this is your practical part. Mostly your practical questions from this only they will ask. Now let's see your theory part or your MCQ part. This is also important. Okay, अगर अच्छा लगा तो लाइक अभी मारना, लाइक और सब्सक्राइब करना. थैंक्स. चलो, consideration deemed to be received. See, you opened an account outside India and that account is approved by RBI. And if you are receiving any amount in that account, any amount, someone is crediting any amount into that account, then it is deemed as if that amount is brought into India. Okay, so this can be asked even in your practical question also. Okay, understand, consideration deemed to be received if that amount is credited in your separate account maintained by the SEZ outside India, and that should be approved by RBI. Done. Next, amount credited in, see here we are saying whatever you are reinvesting from your profits, SEZ reinvestment reserve account, whatever you are putting in this reserve, that should be utilized to purchase a new plant and machinery within 3 years. Okay, if you are not utilizing to purchase a new plant and machinery within 3 years, that amount will become taxable. Clear? Chalo. That is your second point. You should purchase within 3 years another new plant and machinery. If not, that becomes taxable. Got it? No? Plant and machinery new, you must have studied this before also. New का मतलब इसमें दो exemptions है. One is 20% of the total plant and machinery can be second hand. Okay. Second point is that if you are importing any plant and machinery for the first time, then that is treated as new plant and machinery only. Okay. Now fourth point is software deployed abroad at client's place. You have installed some software services abroad at client's place. Even that is also eligible under 10AA deduction. Okay, and then profits earned from deployment of, you have sent manpower, technical manpower at client's place who is outside of India. Even that is also eligible for deduction under 10AA. Okay, I hope this video has made sense. Okay, please do watch all other videos of mine. Definitely worth watching, and it is purely from exams point of view. Okay, so please do like and subscribe and share with your friends. It means a lot, guys. Thank you all so much. See you all in another video.